Okay, debt ceiling done. Have a look at the short end of the curve here. The 1 month rate dropped 74 basis points down to 5.28. I have T-bills maturing on June 13th that I secured. I think my average there is 6.7, 6.8%. Now down to 5.8%. And capital market rates have decreased week over week as well. China announced some stimulus, so Friday the market boost on Friday had some China stimulus in it, had some AI hype in it, had some, I think, misinterpretation of the jobs data in it, but well, it doesn't really matter. And it's Sunday. So I'm doing this before the announcement from OPEC of whether or not they're going to cut another 1,000,000 barrels of oil. That would be inflationary if they did, because it would drive energy prices up. The announcement of China stimulus did a lot to push industrial metal prices up and energy prices up. So that's not disinflationary, that's inflationary. And the debt ceiling has been fixed. So government spending is back on track, which is not deflationary. So if you put those three things together, I'm not sure what the party on Friday was all about, but we invest on the hype and we sell on the news. The bad news actually has to show up here. Look what happened to the yield curves. Bond markets and equity markets are telling two different stories, and those stories are diverging. The capital market inversion, the 2 to the 10, negative 81. From negative 74. That's 333 days now. We're 1 month away from the 1 year anniversary of the inversion of that curve. Look at the 3 month to 10 year. Went from 154 to 181. 27-point drop. 189 is the lowest inversion for this particular cycle. That was on May the 4th. This is approaching 220. Well, not approaching. It is 220 days now. And in the money market with the forward rate, the 3 month forward rate minus the current 3 month, negative 185 from negative 180. So those are all inverting, which is, again, the capital market to money market inversion. The 3 month to 10 year does still have a 100% track record of preceding a recession. The 2 to the 10 doesn't, but every recession has been preceded by an inverted capital market yield, but it's not 100%. Balance sheet has dropped by 50 billion. 43.3 of that was balance sheet runoff under their open market operations account. Balance sheet is now down to 7.6 trillion, 34 billion of U.S. Treasuries. Tips went up by 2.8 billion, but that's really just the capital portion of the security increasing to adjust for inflation. Mortgage-backed securities down 12.2. CDS spreads falling back in line, 36.8, down from 58.87. And money markets still sucking money out of everywhere else, increased by another 31 billion to 5.4 trillion. Retail up 12 billion, institutional up 20 billion. And we have next week probably issuance from the Treasury to replenish the account. I don't know that they're going to be rushing all of this issuance to market to fill it as fast as they can. I think they have a cash flow plan where they see where they need money and how much to issue at certain times to relieve the stress on the market. I think their line of thinking is that the reverse repo facility, which is still over 2 trillion, can probably fill the gap if they issue enough money market securities short term, which means you're going to have a lot of turnover going forward. But if they issue enough short term securities, they might be able to pull money from the reverse repo without dislocating the market very much or sucking a lot of liquidity out of the market. So that'll be interesting to watch, although I don't think it will really make a lot of changes in investment decisions. I don't think it's going to break anything nor change anybody's mind about where they want to be or derail the equity rally. I don't think it has that kind of power. It'll be more interesting to see in terms of where that money is going to come from to absorb all of those T-bills, because it'll be issued in the money market most likely, because you have that reverse repo there that is sitting there for lack of a better home. So if you can give it a better home, maybe you can just shift the money from there, from the reverse repo to the money market, and easy peasy. The June 14th FOMC is 10 days away. In 9 days, we get May CPI. Bank of Canada rate decision is in 3 days. So we get a peek at what the Bank of Canada wants to do. And the last inflation reports we had showed an increase month over month. And our wage inflation is almost double what the forecast was supposed to be. So it is more than, I think, an even chance that the Bank of Canada may move 25 basis points. And then on Friday, you get the Canadian jobs report. Look what happened to the probability of the rate or the June 14th rate decision. The 25 basis point hike, which was sitting at 64% probability, is now only at 25%, and 75% probability, you know what, we're not going anywhere. And this really came on Friday with the average hourly earnings. And I've said this several times. I've said it all the way through Q1, January, February, March. The market is paying attention to AHE, average hourly earnings, as if it is wage inflation. It is not wage inflation. You have to look at the ECI for wage inflation. And the average hourly earnings for January and February and March looked pretty good. Oh, it's coming down. And then ECI came in hot. That's because the jobs report mixes the type of jobs with the qualifications of the individual along with the pay that you're getting. So it's not a clean number, only if it's all one-sided. That if you hired 300,000 people, they all had a BA or higher, and they were all 25 or higher. They're typically the highest paying members out there, and you had average hourly earnings go up 3%. Well, that's pretty good, because you're hiring what would otherwise be the highest paid people, and now that looks pretty good. But when you're hiring high school or less than high school, age 20 to 24, and mostly part-time, no, you can't look at the lower AHE and say, oh, wage inflation is coming down. Well, no, it's not, because it's reflecting the mix of the jobs. So I think that was misplaced. I think these probabilities are misplaced. We've forgotten that CPI and PCE for April showed an increase over March. We seem to just be forgetting that. We seem to just, want to look past it and look for almost any reason where we could attach a story that serves the bull market. Oh, well, you got to trade the market you got, right? Look what happened here for December. The range from 4.5 to 5.75 has all the probabilities are moving down, so that we're 5 to 5.25 now. And one rate cut, we're 30 and 36. So basically staying the same, or one rate cut's got 66% probability. New York Fed effective funds rate 5.08. Reverse repo down 48 billion for June 2nd. And this here, I'm hearing more on Bloomberg about, let's talk about lags now. And it seems to be mixed. You have some guests coming on saying things like, the Fed has raised rates 500 basis points, and here we are. This market is resilient. Companies are handling it. Households are handling it. It's like, well, you're assuming that they've all felt 500 basis points of rates. So you're basically assuming that there is no lag in the interest rate increase, that the increase, once it happens, is a done deal and is history. but almost every Fed official will tell you, and the academic literature will tell you, that a rate increase and a rate effect are two different things. That when the Federal Reserve increases the target rate, that is the cause. The effect still has to be felt. And there are, as you are probably more than aware now, long and variable lags. So, okay, let's put some variable lags, 6, 9, and 12 months. Those are long enough. And if you go back 6 months, that was the effective federal funds rate, 9 months, 12 months. So this is the lag that's still in the system to be felt. That's the effect that still hasn't been fully felt in the economy. Now, that's not saying that nobody has felt them yet. If you think about the economy, maybe 10% of the economy has felt all the rate increases, especially for corporations that have floating rate debt. Maybe they felt all the rate increases. But at the other end of the spectrum, you have households with no auto loan or credit card debt, with just a mortgage at a fixed rate. Or maybe all their debt is fixed rate, where they haven't felt a single bit of rate increase yet. So, we can't talk about the Fed has raised rates 500 basis points and everything is fine. It's the Fed has raised interest rates 500 basis points. If we think it works with a 12-month lag, there's still 425 of those 500 basis point increases to make itself known, to make itself felt. And then on Bloomberg, I heard some guests really referring to the lags. It's like we've seen the rate increases, but we haven't seen the effect yet. And some were saying it takes 12 to 15 months. Some are saying 12 to 18. I heard somebody say 24 months before it's fully felt. Well, we're 12 months in on the first rate hike. So we still have to. We can't just look past those rate hikes. We have to be concerned about that. So if we are going to be bullish, if we are going to be a buyer, I think what we'd want to do is have a look at the level of debt that the companies we invest in have, and whether it is fixed or floating rate, and what their maturity schedule is. Anything maturing in the next 12 to 24 months, I would put a big question mark beside as being suspect. Unless you're dealing with investment grade companies, or the debt is really a small portion of their balance sheet. But this is, especially for commercial real estate, this is questionable. Those lags might not have been felt yet. Okay, real yields have given back just a little bit, but they're staying at elevated levels. We still have an inversion from the 5-year to the 10-year of 20 basis points. Inversion in the real yield capital markets curve, as opposed to the nominal, which is also inverted. Break-even rates not moving around very much. Not much information here. Looking at Fed fund futures, last week we were bottoming out in August at 5.335, or as high as 5.335% implied by the pricing. That's pulled back by 5 basis points, sitting at 5.285, still in the range of 5.25 to 5.5, but less likely on the 25 basis point increase. Going out to December, 5.07 is now down to 5.055, a drop of 1.5 basis points. If the market were open for 3 more minutes like a basketball game, it might have been a different score, right? And going into March of 2024, a drop of 5 basis points. So altogether, you got a drop of 5 here, 1.5 here, a drop of 5 here, implying less higher rates. I don't know that there's much information in there. For the year of 2024, going from December 23 to December 24, down 152 basis points. So basically six rate cuts through 2024, 152. Well, that's more than what we've had over the past 6 weeks. 145, 133, 140, 158 is fairly aggressive, and so there's some belief that there'll be some more aggressive rate cutting in 2024. TLT showed a gain of 0.89%, and actually it did very well on Thursday. Thursday it was 103 and change, and it pulled back quite a bit on Friday. Still had a gain for the week, 0.89% versus SPY's 1.88%. Look at the implied volatility here on TLT. It's gone. It's the lowest. Selling premium just isn't there. There's no value in it. Compared just to a week ago, look at the 13-week IVP. Went from the 42nd percentile down to zero. So I've made no changes on this one at all. I'm short the 104 Junes at I think it's $1.91. So my cost would be 102.09. We're sitting at 101.85. I'm not too concerned on this one. If it is put to me, I'm going to let these be put to me. I'm not going to roll them unless I'm in profit. If if the premiums are down, if we end at 103.50, and they'd be put to me at 104, but the puts are worth 50, and I got 191. I would close them for the $1.40 profit and roll them to July at the 104s. But if it is a lost position, where TLT finishes at 101, I'm not going to roll them. I will let TLT be put to me at that point because I do want to accumulate longer-term duration. Higher levels of duration, which you get from longer-term securities. So I'll take TLT. But I've made no changes over the course of the week. Okay, let's look at OAS, our corporate spreads here. Not doing much. From week to week, there's just nothing to see here. Look at issuance for May 2023 versus May 2022. Investment grade, almost 160 billion issued versus 95 last year. And last May, rates were significantly lower. Rates are much higher now, and issuance is running 60% higher. High yield was 4 billion. 21.7 billion in May of 23. That's a 500% increase year over year. And convertibles, we have none versus 0.1. Year-to-date issuance, 727 billion. That is January through May, which is down 3.8% year over year. January through May of last year, when the target rate was basically still below 1% all the way into May, and we're only down on issuance, total corporate issuance, down only 3.8%. And spreads are, they're basically tight. They're not concerned about anything. Okay, let's move on to housing and mortgage rates. If you feel I'm going quick through the screens, it's only because I feel that there isn't much there that can affect changes for what to do in the equity market. It is being driven by other narratives right now, and I don't know that we get much information from corporate spreads. We haven't had any information from corporate spreads for the last year, basically. So other than pointing out where we happen to sit, it's more or less showing you the screen saying nothing changed, nothing to see here. But saying nothing changed is still keeping you up to date, right? Look at the mortgage rate, 6.79%, up 22 basis points. So the 10-year Treasury Thursday over Thursday contracted 14 basis points. 30-year mortgage increased 22, so the spread increased by 36. You would find that to be a negative, but agency up 4%, Annaly up 6.34%, and Arbor, my little friend here, up 6.33% week over week. Housing still on fire. DHI up 4.98%, and big news on DHI. Remember on its balance sheet, for those of you who have access to the Applied series who've watched the DHI video, it builds communities and rents them out and then sells those rented communities as a package deal. Well, it just sold $4 billion worth of that stuff to a REIT. Sold $4 billion of it, and that was sitting on its balance sheet. So it's got $4 billion in cash coming in, up 4.98%. Lennar up 4.23% after a downgrade to sell. I forget which firm did it, but it wasn't one of these peripheral name firms. It was significant. Downgrade to sell still eked out 4.23% gain. Toll Brothers 4.86, Pulte 5.33, KB Homes 3.53, the XHB up 3.5, Hovnanian down 4.99. A rare in the home builder sector miss on earnings and guidance. I think it was a rare miss on the guidance. The earnings came in, but the guidance didn't on Hovnanian. But they did run up a lot, and then they fell a lot on earnings. And this being down 5% is a recovery, because they were down like 10-11% on the earnings. This was a recovery, so the Friday really helped them out a lot there, but showing some decline. I am long DHI, Toll Brothers, XHB, Lennar, Pulte, and KB Homes. Plus, I've sold puts on these rising prices on homes. You see home prices beginning to rise again. We see up here, I'll talk about that. Plus, we still have a shortage of homes. A negative here is the rising mortgage rates. So that's a bit of a headwind there. I'm also long agency and ABR. I know that says ARR. That should be a B, and ABR. Both in stock and using synthetics. And on Annaly, I'm really just selling puts. I'm not long that one, just selling puts. IYR up 3.28%. Digital Realty, look at that, up 6.5%. That is a data center REIT, and if we're capitalizing on AI, a good AI adjacent play are the data centers, because they're out of space. So if companies are jumping on board, they're going to have to increase their server capacity, and cloud companies are going to have to find more space. So we can jump on board there, but be careful with this guy. Lots of debt on this one. So you can ride the wave, the AI hype, but this is, take away AI, I wouldn't find this an investable stock. But I did go long DLR right around the $100 mark. I think it's sitting at 105 now, and I sold puts on it, but I am renting this guy. I will jump at the first sign of any fear at all or any trouble. I will get out of this. This is just me riding a wave, buying high, selling even higher, because it's got a lot of debt. So be careful with this one. IYR up 3.28%. All REITs went up, as rates are going to remain elevated for some period of time. Cap rates are just not coming along for the ride. They're just refusing, I think, to reprice at a more sensible level, given where property values are, and given with the sheer amount of commercial real estate debt that has to roll over in the next 2 years. You'll recall last week I said I covered half of my short position only because the IYR has digital or data centers in them, and sure enough, they rallied back up to the point of my original short price, what I got on the synthetic. So I put it back on. So that was a nice round trip. It went down, covered half my position on a nice profit, came up, added it back on at the original cost. Mortgage apps for May 26 down 3.7%. Well, that's what you would expect to see when mortgage rates go higher. Both the purchase and the refi index are down. HPI, the housing price index, April month over month, plus 0.6. The forecast was for 0.2. Look at that. 0.6 in April. The forecast was for 0.2. Remember, both the CPI and the PCE in almost every category showed increases month over month. This housing price index 0.6% with a forecast of 0.2. I want you just to think about that for a minute. Canada has seen the same thing. Housing prices are going back up. Bidding wars are back. Just since the beginning of the year, the average home price in Canada has increased by over $100,000 just since the beginning of the year, as rates are this high. It's not as if rates are decreasing, which is pushing up housing prices. Housing prices are going up while mortgage rates are going up. Think about that for a minute. What that means about the shortage that exists. Look at Case-Shiller, month over month for April, up 1.5%. It's a more broader measure because it's looking at the top. There's one that looks at the top 20 cities and one that looks at the top 50 cities. The forecast was for 0.4, and it's up 1.5 just in the month of April. You're starting to get momentum back in there. And if you look at the rent index, it's going back up as well. So the idea that the the housing component of PCE and CPI would show its base effects, and that increases would moderate and slowly disappear. April is saying, Now, if this continues in May, if we look at the CPI for May and we see that the housing is still strong in that sector, I don't see how the Fed can skip a meeting. Skipping is sending a message to the market, and what's it going to do? Increase demand, which will just drive up prices. I think they have to increase rates for the psychology of it. This market rally can't be helping them out too much, although they haven't been too negative on it like they were last August. 1.5 instead of a forecast of 0.4 year over year now. Housing prices are only down 1.1%. If last year somebody said to you, mortgage rates are going from 3% to 6.5% to 7%, and the Fed's going to increase rates 500 basis points, what do you think is going to happen to housing prices? Would you have said, maybe they'll give up 1%? After the incredible run they had in 2020, 2021, would you have said, they'll give up 1%? Well, they did, 1%. The forecast was that it'd be down 1.6%. It's like, no, we're not going that low. We're not losing 1.6% after a 50% run over 3 years. You think we're going to give up 1.6%? Good luck. How can you not be in housing when you're looking? You're throwing almost every bit of bad news at the housing sector that you can. Here's high mortgage rates. Here's a Fed that's going to keep rates higher. Here's tightening credit standards. Here is everything, every negative thing that you could think of for the housing sector, and that's all it can do is lose 1.1% on the housing pricing index year over year, and that this April over March, with higher mortgage rates, is showing housing pricing going up. The big thing here is higher interest rates don't do anything to increase supply. They actually hurt supply because smaller contractors can't afford to build a house on spec and have it financed from the bank, and may not qualify for credit. So higher interest rates do nothing to increase supply. Okay, let's look at some jobs data that we got over the last week. JOLTS came out, openings back over 10 million, 10.1 million. And last month, the number of openings was also revised up. This was the cause for celebration. The quits rate is at 3.793, implying that the labor market is not as tight as it used to be because employees aren't as willing to quit. I can interpret that another way. I can say, listen, if you look at the Atlanta wage growth tracker for April, job stayers are on average getting increases of 5.7%, switchers 6.9%. So that's why you had an elevated quits rate, because you could always do better by switching. Well, how long is our companies going to sit around with a quits rate that high saying, well, it's because they can get more money somewhere else? Well, why don't we just give it to them now? Why don't we just match it? So if your current job is giving you more than a 5.7% increase for staying on average, if it's matching the 6.9, well, okay, maybe I won't quit. So you can see job openings increasing with a lower quits rate, as companies saying, we used to be able to steal employees from other places, but now we can't, so we're going to have to post a job. I mean, I can interpret it the other way and say, no, that is actually very wage inflationary. It's showing a tighter market because companies are more willing to pay up to not have people quit, right? So again, the market has a long-only bias because a lot of funds are long-only, that the the preponderance of the money is long only. So there is a bias to interpret information for the long side. The quits rate is coming down. That's what we want to see. Fewer people quitting because they feel that they can't get another job that easily. Well, then you wouldn't have had, I don't think you wouldn't have had the openings increase if the labor market was really loosening up, and you wouldn't have these kind of numbers over the month of April. A version that matches all the other data a little bit better is that companies are just sick and tired of bringing people on, training them for a while, and watching them walk across the street and get more money, right? So they're going to step up and say, well, look, we'll match it. Initial jobless claims still low, 232. This is not pretty, right? This is from Q1. Non-farm productivity is down 2.1%. So if you have a group of, how we interpret that is if you have, let's say, 10 people and you pay them, let's say, $100 a day, and over the course of the month you don't increase their wages, that you keep the wage constant, and these 10 people are outputting 10 units each, they're outputting 100 units a day, and over the course of the month that drops to 97.9 units. Well, you're still paying them the same amount of money, but they're producing fewer units. So what's going to happen to the cost of each unit? The cost of each unit is going to have to absorb the same amount of money. Costs go up, right? So negative productivity raises unit costs. Look at unit labor costs, 4.2%. Now, the forecast for non-farm productivity was a drop of 2.5%. It was only 2.1%. And the forecast for unit labor cost was 6%. It was only 4.2%. So sort of good news there. But you're still working with negative productivity. That's been in place for quite some time now. Let's look at the jobs report. Two different stories depending on what you're looking at, the household survey versus the establishment survey. Household survey, the labor force increased by 130,000, but those who were employed dropped by 310,000. So the household survey is saying the economy lost 310,000 jobs during the month of May. Unemployed, you add the two numbers up, increased by 440. Establishment survey said no, the economy created 339,000 jobs. Average hourly earnings are 0.33 or 4.03% annualized. And I make the point that is not a measure of wage inflation. Some wage inflation is in there, but it is not a clean measure of wage inflation. The average weekly hours, 34.3 from 34.4. So if you look at weekly payrolls, given that you had increase in hourly earnings but a drop in weekly hours, the aggregate amount of spending power at the malls this weekend is basically unchanged. Let's look at who got jobs. 16 to 19, a loss of 120. 20 to 24, a loss of 27. 25 plus, a loss of 138. Full-time jobs went down by 23,000. Part-time jobs went down by 220. Remember, household has to match up over here, right? High school, less than high school, 26,000 plus. If you had your high school education, plus 266, something less than a BA, negative 377, and a BA plus 44. So your job increases were concentrated down in less than high school and high school, which typically earn less money than somebody with a university education, right? So when you look at average hourly earnings, that is both wage and the mix. If you look at the qualifications of the people that were being hired, they would be lower paid workers anyways, that it would raise the average hourly earnings by a 4.3% annualized rate, sort of hides the fact that wage inflation is significantly higher than what you think if you're taking those that would normally make the least amount per hour and you're still getting average hourly earnings going higher. Because again, the mix of jobs are in there, right? And when you have this kind of discrepancy, negative 310 to plus 339, that becomes a very noisy number altogether. So the market decided to throw a party on this number, and only this number on Friday. This number, when it came out, 339, the market turned down right away. Futures went negative right away. They looked at that, and then they kept looking around and saying, well, hang on. There's your pause. There's your pause right there. Average hourly earnings. And we'll just ignore the fact that it's messy. We'll call it wage inflation. Wage inflation is coming down, and that was the end of it. And we saw what happened on Friday. Let's just ignore that. We'll ignore this side of things altogether. Let's ignore a different interpretation for the quits rate. Let's just focus on one thing. And, when the market is that singularly focused, you can't ignore it. You have to say, well, look, if that's what's going on, I got to get on board. Okay, let's get to the SPY. I've still got more screens to go. Normally, I end with this, but I'm going to move this up, and we're going to do some other things as well. Some ideas that came from comments that when somebody gives a comment, what do you think about this? At first, I don't know what to think about it until I look at it, and it usually takes me a couple of days to figure out what I think about things. And I've looked at two things, and I actually looked at a bunch of other things that I just didn't like, but two of them I kind of like. Let's look at where we are in the market, because like I said on the last screen, it doesn't matter what alternative interpretations there are, or how careful or precise or rigorous we should be about the data. The market is not being rigorous about the data, so you can't be right in a room full of wrong people. And this market has shown signs that it wants to go higher no matter what. Like, no matter what bad news you throw at it, it seems to just say, we're looking past this. But if it's good news, let's latch on to this. That is an asymmetric market that really only cares about bullish data and is not going to care about bearish data. It'll be bearish if it actually happens, but most of the stuff we worry about never happens. And let's not forget that most of the stuff we hope for never happens, but that doesn't matter. There's hope. Let's go. So look at what's going on here. We're above 4,200, and that was sort of a level for a while that the market just didn't seem to want to get across. You finished firmly above 4,200. SPX closed at 4,282. Implied volatility is at a 52-week low. IV last was 11.7. You got to go back to November 21 to get as low as we are now. November 21, while the market was still going up and everything was still great, and there was only rumblings of this inflation thing going on, and the central bank was still buying, still adding to its balance sheet. It hadn't even stopped adding, and here we are, and implied volatility is just as low now. You have AI hype that is going on. Don't underestimate that. You have the belief that this is the end of the rate cycle, and you have strong employment. So the bias to the market is upward until something breaks, because it's not enough to say, oh, wait a minute, there's different interpretation to the data. The reaction will be, yeah, well, when the bad news shows up, let me know. Until then, I'm buying. Get out of my way. And I do think that the bias right now on this market is higher. Based on what happened last week, China stimulus on Friday, off we go. Not to remind people, but stimulus rarely has lasting effects, and it rarely does change behavior. It takes a while to get that done. And to put another note in it, if our capital markets are so reliant on central bank and fiscal spending, what we're basically saying is that it doesn't look like capitalism can stand on its own 2 feet. If it constantly has to be propped up by central bank intervention and government stimulus, kind of makes you wonder, well, what's wrong? What's the problem underlying capitalism itself? And if this is the case, where capitalism must rely on government spending, then the profits that are produced in the economy are primarily a result of taxpayer spending, not just consumer spending, in which case tax rates are too low. You thought you'd never hear me say that, right? But if the profitability of capitalism can't survive without government intervention, then governments are really producing most of those profits. Tax rates are too low at that point. Now, if we think no, that's not the case, well then prove it. Let capitalism stand on its own 2 feet. But every time there's slow growth, even though it's growth, it's slow growth. Oh, stimulus, and it seems like we're just doing this all the time now. I don't recall much before 2008 that there was this much government stimulus in markets, but now it's a word that's just become so overused. Stimulus. Well, I used to say you can't call it stimulus unless it actually stimulates something. Call it government spending. Anyways, China's doing that. So add that to the list of reasons why you're going to go up. Don't think it through. Don't say, well, how's that going to fix the property problem in China? There's already an overbuilding and already an oversupply and already a lack of affordability. You're thinking too much. Stimulus. That's as far as you go, right? So that's why the bias is to the upside. Forward 4-quarter earnings, 223.35. This actually, week over week, we actually saw an increase in this, and some of this is AI related. That AI will increase our revenues this much without increasing our costs, or AI is going to decrease our costs over here. So you're already seeing some of it showing up. Given these fundamentals here, you have a multiple of 19.17 times forward earnings, which seems like a lot, but the forecast for 2024 is even higher. And somebody will tell you, yeah, but if you take the 2024 earnings and look at where the price is today, the market's really only trading at 17 times forward earnings. It's like, how much gymnastics do you have to do to get this done? Let's take an estimate out. Let's jump ahead 3 quarters and start estimating quarter 5, 6, 7, and 8, which we know is just a linear estimate straight up on some growth rate. And then we'll use the current pricing we have today to justify why the market is fairly priced at 17 times. You're comparing money at 2 different points on the timeline. That doesn't make sense. If you're gonna do a forward earnings like that, you got to take the 2024 forward earnings. Then you have to discount them to today at whatever the discount rate happens to be. Then compare it with the price. That's how you get that done. But you can't compare money at 2 different points on the time horizons to say, look what I've done. So you see that, you think, okay, we're really stretching now. Implied volatility is gone. Zero. There is no money in the premiums. All gone. So what did I do to my position? I was short ES for June, and I was short ES for September, and they were in negative positions. I was also short puts that was in positive positions. So what I did was I closed some here for gains, and then I closed some here for losses, such that the gains and the losses offset, such that there was no gain, no loss. So all I did was I lowered my dollar delta beta so that my net on that was 0. I got neutral at a lower dollar delta beta. So now I am neutral in my portfolio. That doesn't mean that I got neutral on my short position. I added a lot of long positions. I added much more on the long side of assets that I'm long, such that I now have a neutral position on beta. And I will continue to do that. I still have a lot of gains left in the puts, so I'm going to continue to do that, but I want to get closer to June 16th. I will roll my Junes into the December contracts, and I will pick up probably close to 50 points of carry. And then my June options that expire with the September underlying, some of them cancel each other out. So I have some calls and some puts, but they'll cancel each other out. Whatever I end up with September, I will then fully hedge out with the puts. I want to grab the carry because I can keep grabbing the carry, and I think that, okay, maybe we get to 43, 44. This is 43 and change up here to get back to the August highs. But is the central bank going to continue to allow this to go on? I don't know. But I would not underestimate that AI hype. And here's why. If you go back to the dot-com era, remember I told you 1999, the NASDAQ was up almost 100%. And a lot of these companies had nothing going for them. No revenues, no earnings, no nothing, just eyeballs. And valuations were ridiculous, but the market just kept saying, but we don't know how to value these companies yet. It's a whole new economy. This is the new economy. The old economy is going to die away. These are different metrics, and everyone bought into that this is different this time. There were no revenues, and it got ridiculous. Well, guess what? The companies today have revenues. So how much more ridiculous can it get? Those companies had no revenues and they got ridiculous. These companies have revenues. So how much of a frenzy can you whip yourself up into by saying this company's already got 8 billion in sales, 10 billion in sales, 50 billion in sales. They're already producing this cash flow. They're going to cut their expenses by 30% with AI and introduce new products that increase their revenue by 30% with AI. So these companies are undervalued by 60%. So Apple should be a $300 stock, not a $180 stock. That narrative will whip itself up into a frenzy because you don't want to think too deeply about it. So if companies with nothing can get whipped up into a frenzy, companies with $1 billion in sales, where do you think they can go? And that's why I think that, looking at, well, where are corporate spreads? What's the Fed going to do? Where rates are? I think we can briefly mention those, but until this hype is gone, and I wouldn't spend so much time on it if this was like Bitcoin. I didn't spend any time on Bitcoin and blockchain. Why? Because it's not a thing. It got hyped up in its own little market, but it didn't spill over into the S&P. It didn't spill over into the broader market, really. It is still its own little thing, and there are a bunch of believers over there, and that's fine. But this is real. This is like the internet. It will change a lot of things. But in time, over the next 4, 5, 6 years, you'll start to see it show up in the cash flows in a more significant way. Not just a little bit here, a little bit there. You'll start to see it show up in a more significant way. But the hype of what it can be can go to a ridiculous place because you'll start saying, well, it can reduce costs by 10%. That 10 will become 12. That 12 will become 20 with a couple more weeks of conversation, and revenues are going to go higher. And you're not going to need as many employees. Let's not think about aggregate incomes in the sense that, well, who's going to be left to buy? Let's just think about, well, this company's not going to need that many employees. So when you look at each company as a micro unit of focus, this company will have fewer employees and higher revenues. And this company will have fewer employees and higher revenues. That when you add up all the companies that will have fewer employees and higher revenues, where are those higher revenues coming from if everyone's going to have fewer employees? But it won't matter. The narrative will matter. The hype will matter. Do not underestimate this hype. I'm not. I'm still negative the valuation of the market. But momentum does not care about valuation. Valuation is meaningless with momentum. Momentum's motto is buy high, sell even higher. Valuation doesn't matter. I know we're buying something that's ridiculously valued, but I have a very good belief that I'll be able to sell it to somebody else who doesn't care about valuation. That's going to be AI. So I am being aggressive in the holding the line, trying not to take a loss, but recognizing that my short thesis is probably not going to play out the way I want it to play out simply because this has shown up. All these things, we're above 4,200. Implied volatility says there's nothing to see here. You have AI hype. You have the end of the rate cycle. That narration will continue. This is another sort of thing that will spur the bulls on shortly. The SPX low was 35.77 on October 12th. 20% off the lows is a confirmed bull market. That's 42.92. The close on Friday was 42.82. You're 10 points below a confirmed bull market. The bull market level is 42.92. The market itself hit 42.90 intraday on Friday, just a smidgen below a confirmed bull market. That if you have a close on Friday above 42.92, add that to the list of bullish things. You are now in a confirmed bull market. I want you to think about that. You are now in a confirmed bull market while central banks are removing liquidity and raising interest rates. You are in a confirmed bull market while productivity is negative. You are in a confirmed bull market while net fixed investment is negative. Think that through. And you have to sort of ask, are we already in the ridiculous area in pricing? 19.7, 19.1 times forward earnings in this environment, with everyone looking past it, comparing 2024 dollars with 2023 dollars, and committing the greatest crime you can with the time value of money, which is comparing money at two different points in the timeline. Otherwise intelligent people doing this who understand the time value of money, shrugging and saying, oh, well, I can convince myself, and if I can convince myself, I can convince a lot of other people, and that's all that matters right now. And I agree. I think that's all that matters. Look at this chart. Here is your line of resistance at 42. Look at what you've had since the lows. Technically, you've got a chart that looks bullish. You've got a lot of other bullish indicators going on, and if you break out to new highs, at least over 42.92, and enter a confirmed bull market, yeah, you can look at a whole bunch of buy orders sitting above there, pushing it another 50 to 100 points higher. 4,400? Could. And if the AI story continues to evolve and continues to get hype, then yeah, up and up you go. And if the Fed does raise rates, the market will say, well, okay, that was the last one then. That was the last one. Now it's over. That's the end of it now. And they will just continue going on. So, yeah. So just to be clear on the last screen about my short beta position, I am not closing that and taking a loss. I am managing myself out of that position using the carry that I can generate by rolling forward and still being aggressive with the puts and the calls, but I will work my way out of that. In the meantime, in the rest of my portfolio, I want to add beta. I've done that with the miners. The miners had a great day on Friday. I've done that with some some data center REITs, although I'm nervous whenever I have to take on something like that I haven't really investigated. I'm just riding the wave, and I hate riding the wave. So I am doing that, and I would like to find some uncorrelated positions to take on, meaning that if the market turns down, these positions will not respond to the direction of the market. So the next two screens are ideas that I got from comments. Somebody asked me earlier in the week, well, what do you think of wheat? And this was Tuesday. And Tuesday morning when I got up, scrolling through my headlines, I saw that Russian wheat was still hitting the market, that Russia had reported its exports for wheat, and they were much higher than anticipated. So that wheat is not off the market. So the price action in wheat on Tuesday and Wednesday was not friendly at all. So this is what we're looking at here is a 5-year futures chart in IB. If you look for a ZW and you look for the continuous symbol, that's not a tradable symbol. It just gives you a continuous chart. That's a 5-year futures chart, and it's the front month futures. Each contract for ZW is for 5,000 bushels of wheat. And I do make the point here of saying Russian wheat is not off the market. The correlation between this contract and ES, in other words, the correlation between wheat and the S&P 500 is virtually zero, uncorrelated altogether. So, if I am wrong and I do lower my negative beta position and the market does sell off, yeah, that's going to bother me. But this will be uncorrelated with the sell-off, so that's not so bad. I drew a line at the lows going back to July of 2020, back into the summer of 2019 here, 572 on the low. This is the invasion of Ukraine, and of course all of that came out of the price, but you can see that you did have a trend up, and then you do have this trend coming back down. But 572, much below 572, it's almost unprofitable to farm it. You would end up having a shortage of wheat because farmers would say, what's the point? Look at the IVP on this thing, 100%. Your 13-week IVP is 100%. It's never been higher. So if you go to the December contract, it finished on Friday at 652.34. And if you back up to November expiration on the options, which has the December underlying contract, by the way, you can't hold the contract through December for the December wheat futures contract because that's a delivery month. IB will shut you down at the November expiration. The $600 put, you get 28 on the $600 put, and that would put you right at 572. So I look at that, I go, well, that's not so bad. How much lower than 572 do we think we can get? You would have to have a wicked harvest this summer. It would have to be the best growing conditions and a whole bunch of acreage under seed for wheat. Well, with global warming, it becomes questionable whether or not you continue to have great summers for harvest. So betting, thinking that it goes below 572, is thinking you're going to have a fantastic harvest. So if you think 572 will hold, you're actually betting against a perfect harvest, which doesn't seem like a big deal. This here, 28, because it's 5,000, generates 1,400 in premium. And because it's a put, and it's so far out of the money, 652 down to 600, it lowers your required margin. Your required margin is 1462. That is almost a 100% return on the margin that you have to post for, getting for a bet that, well, you're not going to get much below the previous lows of 2020 and 2019 when you have hotter and hotter summers with more and more fire. You get one big fire, you can whip through a wheat field like nothing else. So here's what I did. I'm just showing you this one at the 600 because I think that's kind of a low risk place to be with a nice return. What I did on Wednesday after 2 days of selling, I looked at the 690 puts and it had premiums of 102. So I started selling these. I got 12 of them at 102 before they it didn't go much. 102 was the high on this one, and I didn't get my full order filled before it retreated again. That puts me at 588 on the downside versus 572, and the 620s were 45.5, which would put me at 584.5. So 588 to 584 would be my break even. Again, 572 on the lows, and that is assuming that we can have a very good harvest to get much below that. So it seems like a low risk trade. So for the person that pointed out wheat, thank you for that. My first reaction was, look, Russian wheat's not off the market. So my initial reaction was, I'm not a big fan. It's off the market. And then you start looking at it. Okay, well, let me see a chart. Let me see a 5-year. Let me see a 10-year. Let me see where wheat seems to be bottoming out. Let me think about the conditions that we have and the risk reward. There's not much risk, I think. Not that it can't get below 572. It could. You could pull out perfect conditions. You could. Not that it couldn't get much below 572, but I don't know that it would get much below 572 before it might even become unprofitable to actually harvest and deliver. So I'll sit with this trade. This one looks nice. Okay, last Sunday, I did 2 live sessions for the Applied series. Q&A, and somebody brought up a trade I had done years ago, which was the trade between cattle and hogs when the spread got too wide. And they asked about it, and I hadn't been following this trade for some time, so I didn't have an answer. I just said, well, I can't comment on it because I just haven't been watching it for some time. So I called up the charts and I had a look, and the spread, it was in fact quite wide. The spread right now is 105.7 versus a mean reverting level of 50. Back in the early part of the year, the spread was only 84 cents. That's not enough. Like, that's not enough of a spread. Once you get over 100 cents, then it starts to make sense. But that, even though that's wider than 50 cents, it's just not enough to base a trade on. So 105, I did that. The correlation between the spread between hogs and cattle, if you're just looking at the spread and you look at the correlation with the market, again, it is uncorrelated with the market. So I went long hogs and I went short live cattle. So you can see the green line here. Anything above that is profit, and the hogs trade is in profit. This is a short position, so anything above it is a loss, and the live cattle is in a loss. But it is a spread trade, so it is the difference between the gain and the loss that matters. That's the only thing that matters. It would be nice if the trade works out that you make money on both legs, but it's the spread that you're concerned about. So I make money as the spread goes from 105 back down to 50. But I'm not going to hold it all the way to 50. I don't know that it gets back to 50. If it got back to 84, somewhere in there, a 20-cent move on it, then I would probably think about taking half the position off. I don't have a full position right now. I'm short 10 LEs and I'm long 10 HEs for December. And we'll see how this trade goes. It worked well for me the last time the spread got really wide, but I've seen the spread as high as 120, 125. That's why I didn't want to take a full position now, because we're at 105. It could go wider. What troubles me is this. At this point in time, you have cattle moving up, you have hogs moving down, and that's how that spread widened. So there is something in the supply that is causing pork prices to drop and causing beef prices to rise. But we are at the beginning of barbecue season. So these prices may not have found their way into consumer decisions yet. So when you're sitting at the meat aisle and you're looking down at the price of beef and you're looking down at the price of pork, I don't think it'll take much for a substitution effect to take hold over the course of the summer and shift that over the course of the summer. Not only that, it's the beginning of the season. If you had elevated prices back here, March, April, had elevated prices back here, then it makes sense to increase your herd size, so that by the time the herd comes to slaughter, you might end up with a shortage of pork over here and a surplus of beef over here. Economics tells you that these two are substitutes, that the prices of the two can only diverge so far before substitution happens. That's why spread trades between substitutable products are nice trades, because as soon as one price gets too expensive, you will substitute to another one. It's not as if I'm playing a spread between live hogs and golf balls, right? I mean, maybe there was a historical spread between live hogs and golf balls, but there's no economic reason why it should hold. Here, there is a very firm economic reason why it should hold. It's called affordability. And if we, I keep hearing different things about the consumer. And if you listen to food banks almost everywhere are saying we've never seen demand this high. Well, then there must be something going on under the surface that we can't see. When you have government deficits that are 5 and 6 and 7% of GDP, perhaps GDP is government spending. Perhaps capitalism just can't perform, and most of our profitability and income in an economy is actually government sponsored. Maybe we are in a sort of capitalist, socialist environment where capitalism requires the government to work. At least it's just starting to seem that way. So, if you start looking under the surface, just issues of affordability is an economic reason why two products that are substitutes of each other, I can substitute pork for beef, cannot diverge in their price that much. So for the person who brought up the live hogs, live cattle trade for December, yeah, I've looked into it, and at 105, I think it's worth taking an initial position. I don't know that can't go wider. It could go wider. I don't know, but it cannot diverge from its mean reverting level for long. Okay, let's look at the economic calendar for the week coming up. And if we're looking for some kind of risk event in the U.S., there really isn't. There's no real economic report, and earnings season is pretty much over. So all that's left is the narrative. And I think the narrative from Friday spills over. AI, number one. Number two, the Fed is going to pause, and we're done with the rate hiking cycle. It wouldn't surprise me if I hear 2 rate cuts or 3 rate cuts by the end of the year, because the economy is weak. But at the same time, the economy is strong because we've raised rates 500 basis points, and look where we are. Wage inflation is coming down. Did you see the jobs report on Friday? Never mind that it's not wage inflation. So I don't know that there's anything that can derail the narrative this week in terms of economic reports. Now, bad news can break out anywhere, but economic risk I don't think exists. Monday, 10 o'clock, you get ISM. I think other than for 3 or 4 minutes, I don't think that's going to change the direction of the market. Nothing on Tuesday of any interest. By the time you get to Wednesday, the only thing of interest here really is the Bank of Canada interest rate decision. Nothing on Thursday. Nothing interesting on Thursday at all. By the time you get to Friday, it's only Canada with the jobs report. Nothing here that is significant enough to derail anything that's going on during the week. Now again, Monday, if you finish about 42.92 on SPX in bull market territory, I don't know that another 100 points or 150 points this week is out of the question. I'm not predicting that. But I will say it would not surprise me if we went up 100 points or 150 points over the course of the week. Wouldn't surprise me. If we traded to 20 or 21 times earnings, wouldn't surprise me. With AI hype behind it, it would not surprise me at this point. And if the Fed does pause in June, you could end the month of June at 4,500. NASDAQ up maybe 45% year to date. Like, think of something ridiculous. And the reason I'm saying that is because I've seen 1999. I was there. I saw it. And every single day it was ridiculous. You know, you kept hearing commentary of we are in extremely overbought territory. We're due for a pullback. Never happened. Never. The indicators stayed in extremely overbought territory almost all year long. And you heard that almost all year long. We're in extremely overbought territory. The valuations can't be justified. It didn't matter. Think about that for a minute. The index went up 100% in 1 year. After running from November to December, it spent all of 99 going up, and even the first 3 months of 2000 continuing to go up on nothing. This is something. These are companies with real business models and real revenues that can make something of this in 4, 5, 6, 7 years. Don't underestimate this. It will be priced in to the point of ridiculousness if history is any guide. We're already seeing much of the central bank activity taking a backseat. We did hear last week that 1, maybe 2 more rate hikes to go this year, and the market just don't care. Have you heard about AI? That's the newest new. That's the shiny new toy. And momentum. I've said this before, never short momentum, and I can see this momentum thing beginning to brew, and it will get a life of its own, right? So At this point, for my short beta, I am aggressively managing that to the downside without having to take a loss, but I am looking for uncorrelated positions and long beta. No, I don't feel comfortable with it because I know that this stuff breaks at some point and something will break and I'll be unprepared for when it breaks. But right now for me, the pain trade is to the upside, so you got to manage that. That's it for the week.